Hey guys, Dave Keller here with Market Misbehavior. Besides running my own firm, Market Misbehavior or Sierra Alpha Research, I'm also the Chief Market Strategist at StockCharts.com. It's been a blast over the last couple of years to get to know the team at StockCharts better, but also to dig into the platform and learn more about StockCharts.com and try to identify some of the most effective ways to use the product. So today I'm going to present for you 3 hidden features of StockCharts.com. So I've been in the financial industry for going on 22 years now. Most of that was spent professionally in the Northeast, in New York and in Boston at a number of firms. But about 2.5, almost 3 years ago, moved to the Pacific Northwest and joined StockCharts.com as a Chief Market Strategist. And I'd used StockCharts as a platform for many years. I actually first used StockCharts when I was commuting in Boston on a ferry or on a train every day. And a lot of websites and even institutional platforms didn't have very good offerings on mobile, but StockCharts looked fantastic on my phone and an iPad. Still does. So I was able to look at charts all on my commute going into the office, and I was hooked on it. So over time, I've used the platform. In the last couple of years, though, I've really dug into it a lot more as I've used it every day, a lot. And so what I found is there are a number of parts of the platform that I think people don't understand or don't use as much as they probably should. So I want to share with you some of those sort of bells and whistles or tips and tricks that I've uncovered using the platform. I'll probably do a couple of these because there are a number of really cool features on the platform. By the way, if this sort of thinking about investor decision-making, technical analysis, behavioral finance, trend, momentum, breadth, sentiment, if those things are of interest to you, I hope you'll subscribe to my channel. It'd be great to have you along this ride. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Finally, put a comment below the video. Which of these features do you think is most valuable to you and why? Let's get to the charts. So here we're looking at the StockCharts platform. And again, I just want to share with you a couple of things that I found that are really, really helpful. Most of the stuff we'll probably talk about are found in this area of the website called Charts and Tools. If you're just new to StockCharts, I'd encourage you to dig into these because there are a lot of really cool features. Every one of these has something in there. They're not just added for fun. They're added because there's a great value to a lot of these. And the column on the right has a lot of really interesting features that are packed in there. The first thing we're going to look at is called the dynamic yield curve. This is a really fantastic visualization. It's a super simple visualization, but incredibly powerful. It's funny to me because as an institutional investor, when I was working at a large buy-side investment firm in the Northeast, we talked a lot about the fixed income markets. And as a matter of fact, we actually my team sat on the same floor as the high yield team, basically high yield debt. And then we had a whole fixed income division. And especially when the markets were getting crazy, markets were getting volatile and there's a lot of uncertainty, I found it was really interesting to talk to fixed income investors because bond investors tend to focus on risks, right? Your whole goal analyzing a company's debt is basically to gauge the likelihood of them being able to meet their debt obligations, right? How likely are they're going to be able to repay this loan that they've taken from a bunch of investors. And so it's all about the potential risks to the company's businesses. Equity investors, particularly growth investors, tend to think more about potential reward. What is the likelihood of this company to keep growing earnings, and what are all the good things that are going to happen to this company? So it's two very different ways of thinking of things. So I found during bear market phases, it was a lot more interesting, a lot more valuable to talk to fixed income investors because they were, programmed to think about risk and to think about potential downside. They'd already sort of laid out some of the scenarios. It was really helpful to think about also what was priced into the fixed income markets and not the equity markets. That's another thing that, in general, I was always taught that the bond markets tend to lead the stock markets, right? If you have a disagreement, follow the bond markets. Having said that, there's a lot of discussion recently, particularly with the Fed raising rates or starting to raise rates and the implication that they will raise rates through 2022 and in 2023, most likely, and what that might mean. And there's this feature called the dynamic yield curve where you can actually start to understand or try to understand the relationship between interest rates on the left side and stocks, the S&P on the right side. So this is actually the yield curve. And if you're not familiar with the bond markets, a yield curve is basically looking at different maturities. So this is a 3-month treasury bill all the way out to a 30-year treasury bond, right? And you have the notes in the middle, and this is basically the different maturities. So a bond that matures a couple months down the road, or a bond that matures 30 years, like a long-term mortgage, for example. or structured kind of like that sort of time frame. So a yield curve is basically looking short term to long term, and because in general the way a normal economy is sort of functioning is the yield curve sort of has this gentle upward slope, because the longer out you're going, the more yield you should need as an investor to justify owning or lending your money out for that much time, because you're basically lending the money to whoever is issuing the bond, right? And corporate bonds are traded, usually are quoted as or analyzed as a spread over the treasury curve, right? So this is the treasury curve or the treasury yield curve. And then corporate bonds are a little more risky, so there's a little higher yield that's involved with those types of bonds. Now, if you look, we're actually looking at the current day, right? The current most recent day's data. And as you can see, there's sort of this, in general, pretty gentle upward slope to things. But what we can actually do is click here with the mouse. You can actually rewind and see how this yield curve has fluctuated. So let's start at the 2009 low, and this is a weekly chart, so it'll jump a little bit, but you can see what happens. Now, if we start here, you can either move your mouse or you can say animate, and it'll actually fast forward 1 week at a time. Actually, it's going 1 day at a time when you animate it, and you can see how the yield curve is fluctuating. So you can look to the right, see what happened. Nice, slope to the curve, nice increase, 3-month point very low, 30-year point very high during strong economic conditions coming out of the 2009 market lows after the financial crisis. Things continue. I'm going to fast forward a little bit just because we don't have time to sit here and watch this whole thing. But you can see for the most part, the yield curve is sort of functioning normally. You can see, though, in this sort of period, right, 2015, we'll pause, you can see how the whole yield curve started to flatten a little bit. So a lot of times we talk about the yield curve steepening or flattening, and that's literally how the slope of the curve changes. If you think about what a bank does to make money, they borrow money they borrow money at the short end of the curve, and they lend money out at the long money of the curve. So the spread here is how a bank essentially makes money. And so the flatter the yield curve, the less profitable it is for a bank. The steeper the yield curve, the better that is for the bank's business. And in general, a steeper yield curve tends to indicate strong economic conditions. Look at what happened here in 2018. Think about what that yield curve used to look like. You can actually go back to it, and then look what the yield curve looked like here. What happens is actually when things start to get a little squirrely in the economic conditions, you'll get what's called an inverted yield curve, where the shorter end is higher than the longer end. We're almost there right now, actually, here in March of 2022, late March. Potentially could happen. If you look back in history, an inverted yield curve usually comes right before a recessionary period because it shows you that the economy is slowing down, the conditions are not functioning particularly well. So what's interesting, though, is all of that is a narrative about the yield curve. Focus on the relationship. What do stocks tend to do when the yield curve is steeper? What do they tend to do when the yield curve is flatter? And look at where we're at now. And you can look back to historical periods where the yield curve is in a similar configuration and actually see that relationship. So this dynamic yield curve is a beautiful way of trying to bridge the gap between the fixed income markets, which I think are obscure and foreign to a lot of equity investors, a lot of individual investors, and the S&P, which is probably very familiar to you. Look at the two of these together and think about that relationship. And then what I found is this may not answer all of your questions, but it'll certainly give you the right questions to ask to help to understand or try to understand this relationship a little bit better. So first tip, the dynamic yield curve is a really interesting way of looking at the relationship between the bond markets and the stock markets. Second one are the historical charts. If you go back to charts and tools and go down here to historical chart gallery, what's funny is my time at Fidelity, we had the Fidelity chart room, which was this beautiful physical repository of market history, big, huge wall-sized paper charts, big digital signage. We had a 13-foot plasma screen to show all sorts of really cool charts on. And it was really devoted to long-term history of the equity markets and other asset classes as well, the bond markets, the commodity markets, whatever we could get long-term data on, we would put it in a beautiful long-term chart and show it there. What's really cool is on StockCharts, we have this historical chart gallery, which is literally that sort of idea, the type of deep history we would look at as institutional investors, but gives it to all of you as individual investors. So we can see here it's broken into 4 different areas, market indexes, so major broad indexes, not just equity indexes, by the way, but other markets as well. fundamental data, so particularly earnings and PE ratios, valuations, market breadth indicators, looking at long-term indications of breadth, and then the presidential cycle, looking back and seeing how the market has performed during different presidential regimes. So we're not going to go through all of these. I'd encourage you to experiment it on your own. But just at the beginning, this is the Dow Jones Industrial Average going back to 1900. 1900. So you're going back over 100 years, 120 years of market history. So when people talk about secular bull and bear markets, when people talk about the 1970s, the go-go years of the 1960s, the 1980 and 90 bull market, the 87 crash, the flash crash in 2010, anything else, you actually have charts. You can actually see the data and see what these indexes actually did. One of my favorite charts is right, or parts of this chart is right in the middle. This is basically the 1960s. And if you've never heard of the go-go years, there's a book called The Go-Go Years. I'll put a link in the description below. Fantastic story about Wall Street in the 1960s. Completely different era, a completely different feel to a lot of things, but you will learn why it was actually called the go-go years on Wall Street. Then the 1970s happened, and you have the 1970 the secular bear market in the 1970s. The Dow actually first hit 1,000 here in 1966, 1967. We hit 1,000. It took about 16 years for the Dow to actually go back above 1,000 for good. Look at how many times the Dow literally hit 1,000 and just kept bouncing right back off of it. That is the definition of a secular bear market, where you hit resistance and it is just never really overcome. You can see that in the 2000s, which was another secular bear market, the Dow actually far eclipsed the 2000 high in 2007, but the 70s were actually very different. It was a very consistent, very flat resistance. And I know, analysts at the time were wondering, are we ever going to get above Dow 1000? That's a 16-year period where we didn't. But then in 1983, we finally got above 1,000, and for good so far, right? So you have the 1982 low here, which was pretty key, and then 1983 we finally get above 1,000. So it took about 16 years to get above that level. So what's interesting is look at how long that is. When people talk about is the bear market over, and we're in this little blip about a couple months into a downtrend, I'm thinking, listen, this short-term tactical little move could absolutely be done, but secular bear markets, if we actually get into another secular bear market, these take a long time to get through. These will be, years and years, and there can be big cyclical uptrends and downtrends within this secular bear market phase. And so it's a great reminder of just how long these market cycles tend to last. It's also a beautiful reminder of the long-term upward trajectory in the stock markets, right? If you look at any long-term history of equities, you can see why it tends to be a good place to invest your money, particularly for retirement, because in general, over the long term, regardless of where you actually start the clock, you're going to end up in a much better place as long as your runway is long enough, as long as your investment horizon is long enough. So, talking with clients, thinking about, the long-term prospect for equities, some of these charts that show you the deep historical data and show you the trend in markets over time is really valuable. By the way, there are two charts behind me, and there are actually two other charts, paper charts in my office over there off camera. I look at these charts every single day and multiple times a day when I come in and out of my home office if I'm working from home. This one over here is a history of U.S. interest rates back to the early 1900s. This here is major equity market averages going back early 1970s, so starts in the 70s bear market and then goes up from there. But I have really long-term charts of market history, and all of that is meant to help me get away from the short-termism of financial analysis, get away from the flickering ticks, the real-time data, and just think about the long-term trends. Make sure I'm trading and particularly investing with the long-term trend in mind. So that sort of idea of having these big long-term historical charts, you actually have access to them electronically through StockCharts. So that's called the historical chart gallery. And again, we looked at just this one segment. I'd encourage you to look at some of these other ones if you really want to understand the relationship between price and earnings, and look at valuations and where we're at now relative to where we've been. There are a lot of great historical charts that can help tell that story, not just today, but over the long term. And again, as institutional investors, we debated endlessly what today looks like relative to other periods. Does this look more like the mid 1980s or the 1950s or 99, and why? And start to look at the different relationships. You can start to do that sort of analysis on the historical chart gallery. third thing I want to share, this is actually a really cool one. It's called the Chartsvoyeur. And basically what you can do is these are actual charts that different stock chart users are creating. Now, they're not attributed, so you obviously can't see who is looking at this chart. You can't see any annotations, so all of those are removed. Any text or anything like that that would tell you what someone is actually looking, thinking about these charts. But the charts themselves with the indicators are posted on here. Why I think this is so interesting, because I found as a technical analyst, I learned a lot over my career seeing how other people are looking at the markets, not just, finding people that have been successful and trying to emulate or imitate the things that they do so well, but also seeing examples of bad market analysis and trying to avoid that. So I love looking at this list. And again, these are charts that people are creating earlier in the day whenever you bring it up, and it'll just kind of cycle through them. I wouldn't spend your whole day staring at something like this, but it can be very interesting to just see what types of charts people are creating and think about what is it that they're probably looking at? What are they trying to, what story are they trying to tell? What thesis are they trying to prove or disprove? What tickers are they looking at? What tickers are being looked at more often than others? Any key ratios? That was small cap versus large cap. Does that tell you anything about, have I really thought about that relationship of small cap stocks? And it's not just a way to see what's moving, because, obviously any ticker that someone is looking at, they're probably looking at for a reason. So it tells you, the tickers that bubble to the top and are shown on the screen more often tell you the things that people are looking at. But it also is a great illustration of some of the different charting techniques. And I found sometimes someone will use something on here. I think, why don't I ever look at trend channels anymore? I used to pay a lot more attention to that. Should I think about that in terms of the relative strength of growth versus value? And it causes me to think about new patterns and new charts to sort of reflect on. So that is actually called the Chartsvoyeur. It's updated all during the day. And anytime you bring it up, I found if you're just sort of stalled out and you have a moment, it's an interesting thing to look at, to see what tickers people are analyzing, to see what types of charts people are using, and see what indicators are being used. And again, I see plenty of examples of great, ideas. I find good examples that I think, wow, that is a style, that is a look that I've not used that I should probably think about a little bit more. I also find some examples of poor analysis, and I think, wow, that's probably not something I want to do. But either way, it helps me reinforce my own tool. It helps me question how I'm analyzing the markets. What's on my chart? Are my charts way too busy? Are my charts way too simple? What tools and techniques am I using consistently? Which ones have I not used in a while that I think, wow, how come I stopped using point figure charts or whatever it is that comes up on that list? So there you go. Those are three really interesting hidden features of stock charts. So again, using the StockCharts platform for a number of years, I'm starting to uncover some of these different hidden features, things that I may have known were there, but I just haven't used in a while, or other things that I just wasn't familiar with until I really dug into the platform. We talked today about the dynamic yield curve. And again, if you're not super familiar with the language of fixed income, it's a really interesting way to get started, just to think about the relationship between the yield curve and the equity markets. I think really topical and really important now. The second thing, the historical charts. I think, when I've worked with institutional investors, we tend to have a really deep familiarity and respect for market history, learning the lessons of investors that have come before us. I find individual investors in general tend to be way too focused about the now and not enough on the learning experiences of previous market regimes. Those deep historical charts can help you see what an actual historical period looked like, what it felt like, and try to understand the dynamics at play so you can start to anticipate what might happen now if we have a similar combination of circumstances. Finally, the Chartsvoyeur, which is a way to see what types of charts other people are using. And again, I think it's helpful. Again, it's not meant to it's not attributed, so you really can't tell who is looking at what and for what reason, but it does two things for me. Number one, see what sort of tickers people are bringing up, because a lot of times I find something comes up and I think, for example, right now, when we looked today, it was small caps versus large caps. I haven't looked at that ratio in a couple of days for some reason. I was like, all right, I want to check that out and just see what it's telling me on my chart. Also, it's just helpful to see what types of indicators people are using. I found a lot of times I will get away from something, I just haven't used it in a while, and seeing what types of charts people use help me to reinforce what is in my current toolkit and help me think of some ways I might want to expand my own toolkit. Are there tools and techniques that I haven't explored in a while that I might want to? That's it for now. If this sort of thinking about investor decision-making, technical analysis, behavioral finance is of interest to you, I hope you'll subscribe to my channel. Also, give the video a like if you appreciated it. We'd very much appreciate that back. Finally, put a comment below. Which of those 3 features do you find most interesting and why? Let me know in the comments. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. Talk to you soon.